by way of just sort of rules, anything goes as far as I'm concerned. Any kind of a question, anything that's outrageous, if for some reason you have a completely different point of view on something, or if you find something that you feel is technically an error, by all means, correct it. Because this is supposed to be a learning experience. None of us know it all, but so I'll do my best to kind of help you all maybe get to at least most of my work for the last 20 years since I left the university have been very much related to consulting and to doing rather than just thinking about things. And so I'll try to kind of help you put it all together. I might surprise you a little bit by saying to you that I've actually changed the beginning of this lecture as a result of this morning's newspaper. This morning's newspaper on the B section, the second section of the paper, has a headline, and it says, "Loyola President rebuked by faculty." That's this morning's paper. And it would be inappropriate for me as a trustee to try to debate this, nor am I trying to really come into any sort of conflict with what seems to be the majority, at least, view at the moment of the College of Arts and Humanities. However, since you are business students, perhaps you might find it interesting to at least understand what this is all about, at least from the trustees' point of view, because the trustees, remember, their responsibility to the university, both from the standpoint of a pledge that we take, as well as legal guardians of the university. It is our job to use our independent thinking, coming together in a collective way to decide what is best for the university. And unfortunately, the trustees, the president, and the administration seem to be pretty much at odds with the arts and humanities faculty at this moment. On one level, what we are dealing with is a greatly downsized budget and a greatly downsized university as a result of the catastrophe a year ago, Hurricane Katrina. And a tremendous amount of work has gone into this, looking at budgets and plans and future plans, what our enrollments will be and so forth, in order to make certain that we act in the interest of the long-run development of the university. And what that really means is all of the university's stakeholders. And I suppose, as you probably know, that is certainly first and foremost the students. Secondly, it would be the faculty and staff. Third, it would be the community. Fourth, and I'm not sure it's just in this kind of an order, but certainly all of the alumni. And finally, the role that Loyola should play in higher education, because it's a very, very diverse subject. Higher education in the United States is probably the most eclectic, the most diverse, the most remarkable form of higher education anywhere in the world. And so on one level, the trustees and the president are trying to come together with a strategic plan which is appropriate in the short run for a downsized situation. And many people in the faculty think that we should tap into the endowment in order to fund this short-term thing, and that everything will come back hunky-dory. The trustees were very nervous about that, and we didn't decide to do that. They thought a better plan would be to look at the whole university and ask ourselves, what can we do with, in the short run anyway, smaller resources? But that really is only the tip of the iceberg. Beyond this, higher education in the United States, not surprising, like everything else in the United States, is going to undergo massive fundamental change. It's already started to do that. That which is very, very clear, and it's visible in the terrain of change, is that the role of the private university versus the state university is changing significantly. The state universities are well funded. Many of them have become very, very world famous. And so therefore, there's a new level of competition between a private university and the state universities. And so as you think through Therefore, what is the role of a school like Loyola in the future? It isn't necessarily the same thing as it was in the past. Because if you look at Catholic higher education in general, Catholic higher education actually emerged about 100 years ago in order to serve the growing constituency of immigrants who were Catholic, mostly from Middle Europe and Ireland. These people, they were affluent in the first, and certainly in the third generation. And they weren't necessarily, didn't have the resources, or didn't necessarily have an easy way to get into, let's say, some other universities. And so actually the role of Catholic universities was largely to take care of originally this Catholic population, which comes from this remarkable immigrant stock, which a lot of us are from that particular background. And my father, incidentally, very early in the last century, in the 1920s, he studied at night school here at Loyola. He studied accounting. He couldn't afford to go to university in a 4-year configuration, so he went to night school. He was so successful doing that, he got his older brother to do that, and his older brother ended up getting a CPA, and we had and that firm still exists here in New Orleans. But that role has changed. That's one of the controversies that's going on right now. In other words, one of the things that we gave up was night school, or the orientation to serve the community broadly here at Loyola. And you might say, well, gee, why would you want to do that? Well, one reason we want to do it is because Tulane is next door, and they're so well funded, and they're so much bigger, and that they do such a good job in that in a sense we were, quite frankly, and also ran in terms of part-time night school education. And maybe in view of what's happening in the community, we didn't need to have Loyola next to Tulane doing kind of the same thing. Plus, there's all these other universities around, including UNO, which has a large evening program. And so one of the things we gave up was that, because what we really know is that we want to do better that which we do best, which is undergraduate education primarily for 18 to 22-year-old individuals such as yourself. But looming on the horizon is something which is much bigger and much more consequential than anything that I've talked about so far. In 1976, a professor at San Jose University, his name is John Sperling. He and a small group of university professors in California looked at the whole subject of higher education, how it was being taught, how it was being delivered. And they said that the model that we now have, which is the 18 to 22-year-old model on large geographically oriented campuses, is not the model for the future for at least certainly adult education. And they formed a company called the Apollo Group, which is best known to those of us who know anything about the subject at all as the University of Phoenix. The University of Phoenix, in a 30-year period, has literally become the Walmart of higher education. I'm not suggesting that you drop out of Loyola and all of a sudden go enroll in the University of Phoenix. I have a stepdaughter who is in your peer group. She's a junior, and she's at the College of Charleston, which is a school similar to this. And I'm very pleased that she's at the College of Charleston, because what we have to offer here at the College of Charleston and several hundred other places like that is a kind of rounding which you will not get at the University of Phoenix. Because when you come here at 18, you have a lot of growing up to do. Just think back upon the 4 years. Most of you are seniors, right? Just think about how different you think and act now than you do. I hope so. Than you do when you come here as freshmen. And so what we're trying to do here is we're dealing with the whole package. And we're dealing with that whole package in terms of education, yes. We're dealing with it in terms of social development. We're looking certainly to some extent to religious, ethical issues and philosophical issues. All the things that all the benefits that you have in this total package. And incidentally, one thing for certain, and that is that the trustees, the president, and the administration of the university are committed not only to maintaining that package, but enriching that package in very, very meaningful and significant ways. So that, in effect, what we want Loyola to do is to have a stronger differential advantage in the future than it does at the present time. Because we want to, as a very famous business person, business scholar, I'm sure you've heard his name in the 4 years you've been here. How many people here have not heard the name Peter Drucker? Good. Well, I don't know. I didn't say anything very good about our school then. Are you a business school graduate?
I'm a music business.
Okay, that's right. Well, you need to know the name Peter Drucker. Peter Drucker was the most famous professor and the most famous, probably, intellect of the 20th century. He just died a couple of years ago in the 20th century. And Peter Drucker coined this remarkable phrase. He said, concentrate on the 20% of the things that produce 80% of the results. Do those with excellence, and the rest, not at all. Okay? Let me repeat that. Concentrate on the 20% of the things that produce 80% of the results. Do those with excellence, and the rest, not at all. Basically, that's what we're doing here. And I think for that reason, Father Wiles and the promised Professor Harris, they have a good bit of enthusiastic support because that's probably a really, really good thing for us to do. We have to be very objective in evaluating who we are and what we can be in the future so that we have a true differential advantage. Because after all, in a sense, we are subject to the market mechanism. This may be a non-profit business or a non-profit entity, but it is certainly subject to the market mechanism. Let me take a minute just to tell you how successful the University of Phoenix has become, and how powerful it will become. And the importance of it is not only to look at it today, but think about what's going to happen in the future. In a 30-year period, this has become the largest higher education institution in the entire world. It has 350,000 students worldwide. It is the only university, really, which is not only, in a sense, becoming a national university, but an international university. It's in a whole lot of countries, very large and very important in China and India. I will tell you something, won't it? And these are some of the numbers you might find it interesting. The size of the university last year, its sales volume was $2.25 billion in sales. Put that in perspective for you, the budget of Loyola is about $100 million. Downsized now to about 85, but it was 100. Its profit, after-tax profit, was 4.5 times the size of Loyola's total budget, $445 million. It has 32,600 employees. It operates at the present time at 244 locations. At 350,000 students, it is 7 times the size of the largest two universities in the United States, which are the University of Texas and Ohio State University, single campus, that is, 50,000 students each on those campuses. But the compound rate of growth is so phenomenal, it grew 25% last year. The market capitalization value of this company, and is that a common term?
Market cap?
Yeah, market cap value. In other words, if you add up the share price of every share of stock times the number of shares that are outstanding, the market capitalization value of this company is $9 billion. Now, why is that important? Well, certainly it is certainly an example of an entrepreneurial business. 30 years ago it was an idea. Now it is one of the top 500 companies in the United States. And so that, in and of itself, makes it, I guess, worthy to discuss in a class like this. But with its compound rate of growth in sales and earnings, with its radical innovations in terms of computer technology and online learning, this is the tip of the iceberg. This company is today probably where Walmart was when I was very involved with this company in the late 1970s as a consultant. And I had the privilege and pleasure of getting to know Sam Walton very well. And these are the kind of things students kind of like to hear. And so I was involved as a consultant to Sam and to the whole company, my company, as a consultant. consulting company we did a lot of work with, Walmart. And Mr. Sam was a very interesting man. He had this patina of, or I should say more of a persona as being a sort of a hillbilly, but behind that persona was a very sophisticated man who played tennis every day, had his house designed by Frank Lloyd Wright's most famous student. He was a very, very remarkable human being. And when Sam Walton died, he was the single richest man in the world. And today the Walton family, the collective family, which consists of a mother, his wife, and there were 4 children. Unfortunately, one of them died recently in an airplane crash. They're now 3. But the Walton family's holdings in the company alone, not necessarily the private investments they've made, is $100 billion, which is twice that of Bill Gates' fortune. And of course, one of the things that you probably would be thinking, or certainly a lot of people with a totally different perspective, is why should any one family have $100 billion? What is it about that family and that deserves that kind of wealth? And this is a very, very difficult and sensitive issue. What is wealth and what do you use it for? In the case of Sam Walton, interestingly, he didn't do this, based upon the kind of dramatic technology breakthroughs that Bill Gates did, where he got in on the very beginning of the whole computer revolution. But he did it, he started out running a dime store, literally, a franchise dime store in 1946 when he came back from being an Army soldier in World War II. And in 1948, everything was going fine. He was making a living for his family in this one store, but he only had a short lease, and the landlord saw that he was so successful in this franchise store that he didn't renew the lease after a 3-year period, and he put his own son in that location as a franchisee. And so Walton had to leave this town, and he ended up in Bentonville, Arkansas, which is still the headquarters of this worldwide company today. And he opened a little variety store there, and then he opened another one. He had about 8 variety stores, but in the early 1960s, at the discount house, or the discount department store, we call it today, Revolution, he decided that these variety stores were too small, and they weren't the wave of the future. The Kmart Corporation had just emerged out of Kresge. Kresge was an old variety store company, 100 years old. Almost, no, not at that day. It was a 70-year-old company in 1961 when this happened. And there was a man that was given the job at the Kresge company to look at the future. Kind of like, in a way, the president of Providence are given the job here to look at the future. And interestingly, what this man did after he was given a whole year to make this study, and these bigger, large surface discount stores were kind of cropping up. They were very primitive in those days, but they were cropping up everywhere, and they were definitely beginning to become dislocated. It's a very important term, because if you think about what entrepreneurship is all about, it's about the really successful people that are entrepreneurs. They not only create change, but they create dislocated change. They do things so well, so differently, that they kind of really ruffle the feathers of the establishment. And this was going on in the Kmart Corporation as a result of this study. And to make a long story short, the person involved came back, made a report to the board of directors, and said, the future is in these large surface stores, and these old-fashioned variety stores that we operate truly are an economic anachronism. And if we don't move from this format into the large surface format, there will be no future for us. The board of directors made him the president of the company to drive this new business, and which he did. And I wasn't very many years older than you at the time, but I did have my PhD, and I happened that that was my field. My field is retail, and I had done a lot of studies of the potential emergence of this new form of retail. And I was invited to attend the meeting in Detroit where the announcement was made that the Kresge Corporation is going to go into these large surface stores called Kmart. And they brought in 40 store managers, the best 40 store managers they could identify, plus all the senior management of the company to make this announcement. And one of the things that I remember best about the meeting when it was said, it was looking around the room at all these people who had heard this for the first time, and the comment was made, now some of you are thinking this is a test. But I've got news for you. This is not a test. This is an installation. We are not going into this business to see if it's going to work. We are going to go into this business to make it work. So they have that much confidence, that much determination to open 40 stores simultaneously. And that was the beginning of Kmart. Kmart, incidentally, grew so rapidly that it surpassed Sears Roebuck and JCPenney, which were an older format. They were national chain. They were department stores operating multi-level businesses, as opposed to the single surface central checkout and so forth. And so they did that, and they were the biggest. They were at the time that we're talking here, early 1960s, when Sam Walton opened his first store in 1962. They already had 100 stores open, and their rate of growth was phenomenal. And little old Walmart was kind of a silly thing compared to this new, exciting momentum of the Kmart company. But Sam did it kind of one store at a time, one here, one there, and then it was two here, and then it was three, and of course, obviously, today, for example, Kmart in the United States, Walmart in the United States alone opens 350 new stores a year. These stores are over 100,000 square feet in size. Walmart spends today $1 billion a month in capital expenditure on new store development and the redoing of existing stores. But then, so how could this entrepreneur, by the name of Sam Walton, very nice man, not an uneducated man, by the way, university graduate before World War II, married a lady with whose father was a banker, had a little bit of money to lend them to open the first store, so they didn't do it. Walmart did not emerge from what might be called a micro entrepreneurial innovation. Those are also very interesting. The best example of all micro innovations is probably Subway. It was started by a kid your age who was at, I forget what university he was at, but he opened up a sandwich shop. And there were a few hiccups along the way, by the way. It wasn't just quite completely linear, but almost. Today there are more Subways than any other food business in the world. I think approaching 30,000 individual outlets. And every single one of them except for the first one, is a franchise outlet. None of them are owned by the company. They're all franchise. And this was all started by an individual 20-something years ago who was not even 20 years old when he opened the first store. So that started as a micro business. That was, $1,000 here and $500 there. And it was really a tiny business. And nothing wrong with that. You've got something that will really work. Well, Walton didn't do that. I don't know what it cost for the inventory and the fixtures and everything for the first store, but he borrowed the money. I know what it cost. He borrowed $20,000 from the bank or his father-in-law, and he had $4,000 that he'd saved while he was in the U.S. home. It was a $24,000 initial investment. That was in 1946. The first store we're talking about is a large service discount store, Walmart store, was 1962. Somewhere in the late mid-'80s, because of some problems that Kmart Corporation had from a leadership point of view, bad management decisions, the company kind of stalled, had enormous problems, and Walmart shot past Kmart like a rocket ship and never quit growing. Today, Walmart is the largest company in the world, sales-wise and employee-wise, not necessarily profit-wise. As a matter of fact, the profits of ExxonMobil are several times that of Walmart. It's in a different business, and sometime I'm sure that we could get into a discussion of why do they make so much more money than Walmart on lower sales. And the answer, of course, somebody ought to know the answer. What is it?
Higher profit margins.
Why? Why do they have and why do they need high profit margins?
Because of the inelastic demand.
No, I don't think they.
They just they have a larger risk. I mean, they're putting people out on these oil rigs, and they have human capital risk, and they need to be a little bit smarter. I mean, the person running operating an oil rig is more at risk than the person behind.
And how much do these oil rigs cost, Katie?
How much
do these oil rigs cost?
Oh, how much
I'm not asking you to give me an answer. Is it a little or a lot?
Oh, it's a lot.
It's a very capital intensive. It's a hugely capital intensive business. And the amount of money that is invested by the ExxonMobil Corporation in order to generate its dollar in sales and generate its dollar in profit is enormous compared to a general merchandise retailer. What is it about? That's such a fundamental point that maybe I can give you one little example to help you understand it. Years ago, I had this goes back 20 something years ago. I had the privilege of being the summary speaker on a large convention called SMI, which is Supermarket Institute of America. And I was followed on that program by Hubert Humphrey, United States Senator from Minnesota, and then followed on that by Gerald Ford, who was United States President. And my mother always kept that particular program to show who I was on the program with, because I'd never had that experience before. But nevertheless, I was the last of the business speakers, and then these guys were the cap-off speakers of this convention, which was in Washington, D.C. And I remember the President of the United States sent a telegram to this group, the Supermarket Institute, which are the managers and owners of the most efficient, quote-unquote, retail businesses in the world, congratulating them on their efficiency. And he mentioned in the telegram, your business is so efficient that only 1% of your sales goes to net profit, which is, by the way, was about true on an after-tax basis. The supermarket industry, 1% of sales is for profit. The rest is for cost of goods, overhead, stores, everything else goes in front. And this didn't actually happen, but let's suppose, for example, that a month later, that the jewelry trade association met in Washington, D.C., and they probably wouldn't have gotten the same telegram from the president, because their profit after taxes is about 6%. And so maybe the president, if he sent a telegram at all, he might have to say, gee, you guys really ought to work harder because you are terribly inefficient, you're gouging the public, and you're charging too much and you're making too much profit. As I say, this didn't really happen. But why would a jewelry store have a 6% after-tax profit and a supermarket have a 1% after-tax profit? Okay.
Jewelry store has a higher turnover rate. I mean, lower turnover rate. So the
turnover of what?
Of merchandise.
Okay. How often does the merchandise turn over in a supermarket? What? In a year's time. That's what we mean by turnover. Take a guess. Well, let's suppose you go over to Whole Foods and want to buy some fish for the night. How long do you want that fish to have been there? Maybe less. It costs. And if it was a steak, maybe a week would be okay. If it was a can of peas, of course, it wouldn't make any difference. But so to give you the answer, a large American-style supermarket will have an inventory turnover about 26 times a year. By the way. How often do you think the turnover of the average? What do you think the merchandise assortment? You look at a jewelry store. How often does that inventory turn? A good a good inventory turnover in the jewelry store is 2 times. So in order to build an assortment of diamond rings, and this, that, and the other, watches, and all things that are in a jewelry store, it just doesn't turn over that fast. So the amount of money invested in the inventory on average for every dollar of sales is hugely different from one business to the other. You see that? Now also, when you go to you go to even the Whole Foods, which is kind of on the upmarket fancy side, you go to get to the checkout, you have to pay cash or what? Or a credit card, right? But the supermarket itself is going to get within either that day or the next day cash. You understand what I'm saying? Because even if you buy on credit, they get the money the next day or the third day. Suppose you go to a jewelry store, however, you may actually, not only when you buy it, they may offer you what? Financing. They might offer you 6 months, because and it might even be in a highly competitive market, they may 6 months with no what? No interest. So if you look at the not only does the jewelry store have to have a tremendous amount of money invested in the jewelry, in the inventory, but then they don't even get the cash when they sell a lot of the inventory. So what we're really saying is that the asset investment per dollar of sales in the jewelry store is hugely different than it is in a food supermarket with 26 times turns a year and cashing out the next day. And so, going back to our ExxonMobil example, for every dollar of sales that is generated by the ExxonMobil Corporation, the number of dollars that are invested to get that dollar of sales is huge compared to the Walmart example. And that's the difference. And one of the things that I'm going to urge all of you to do, since you are really in the fall of your senior year, and maybe we can even work on that a little bit as a group, is that I am, I'm a former professor at a major university, and I've taught undergraduate, MBA, PhD, and I am always amazed at how difficult it is. I don't really think it is difficult for the students to learn, but for some reason we have done a poor job in every place that I've ever experienced in really grasping this fundamental issue, the relationship between the balance sheet and an income statement. We've all had accounting, we've all had finance courses, but somehow you don't get it. You don't really get that this business about how do you take a certain number of dollars, invest them, and then what kind of sales can you expect, what kind of expenses can you expect, what kind of profit would be left, and is that profit adequate enough to justify the amount of the investment and the amount of what? What's the other word? Risk associated with that investment. Right. The amount of the investment and the amount of risk associated with this. Why would if you had a certain amount of money that you inherited from Aunt Mamie or somebody and you decided to invest it, why would you get a higher return if you had a mutual fund than you would from a government bond? What?
Higher risk.
Sure. In other words, if the government bond is about the safest thing we have. The United States is a pretty stable country. It's the richest country in the world. How much risk is associated with buying United States bonds? Have we ever defaulted in the 200 years of the country? Never. Never. Is it likely that that's going to happen? It would be a catastrophe of such enormous proportions that it's almost unthinkable. But on the other hand, as a young person, you really don't want to invest in government securities. You want to invest in securities which have higher risk but give you higher return. And you want to start really thinking about this at your age because of what's known as the magic of compounding. If you at age 19, now I realize most of you are probably over here right now, 20, 21, and 22. if you will do, I want you to just write this down. If you started at age 19 and invested $2,000, each year, and let's say a portfolio, a diversified portfolio of mutual funds, which would return to you a conservative return of about 9%, and that would be a very low performance in terms of a long-run return on stocks and bonds, on stocks mostly. And if you did this, you see, I'm going to get down here in a minute, and I will add this all up. And I'll tell you what it comes to, because it comes to $16,000. Now, if you had invested that at 19, 20, 21, and 22, now some of you are a little bit behind, so you're going to have a few less parties and work harder. Okay? Because you got to do this. Do you have any idea what this $16,000 would be worth at an 8.5% yield at age 65 when you retire? Want to take a guess? $1,035,000. Now, every year you wait, it's going to be much harder because of this magic of compounding. Question?
Yeah, that's 40 years from now. So 3% inflation rate on average, it's not going to be worth as much in the future value.
That's absolutely correct. You're absolutely correct. That's even more of a reason, instead of doing 16,000, to do 32 or 64. Because when you retire, the way the federal government's spending money it's almost another story beyond the agenda of this meeting. But the way you're absolutely right. That is not going to be $1,035,000 in today's purchasing power. So that means that what you really want to do is to end up with much more than that if you want to look upon how to live another, because again, at 65, by the time you all get to be 65, the average people might be living to 100 on it because of the technology and everything, the remarkable things that we're learning, not only about medicine, but about not smoking, about diet and exercise, the whole darn thing together. So, and by the way, I won't ask this on a personal basis, but if anybody in this room smokes, all you got to do is quit smoking and you automatically get some money. It sounds stupid smoking, your side of the back will kill you. So anyway, what we're trying to do here is to give you some feeling and sense of what it is like to be an entrepreneur. How do you get started? The next time we're going to talk about a real case study, which happens to be one I'm involved with my sons. And that is the development of a restaurant business. We started with a single restaurant 25 years ago, which, by the way, that restaurant is still in the family. And but it was kind of a high-end, not super fancy, because part of the positioning strategy was to make sure that it was right for the time. And that original restaurant, which was in a historical area, a little bit like, let's say, the Garden District or something, it started at the same time that the Brennans bought a restaurant called Commander's Palace. And they turned that into one of the most famous restaurants in the world. That family was in the restaurant business. And the man that founded that company was a true entrepreneur. His name was O.B. Brennan. And O.B. Brennan founded the restaurant right at the end of World War II. He was as I remember, I'm not sure I've got this right, I think he was an alcoholic beverage salesman for one of the distributors or something. He decided to go into the restaurant business, and this much I do know, that everybody around town was kind of snickering and laughing because this was an Irishman that was not considered terribly refined or terribly knowledgeable about the business. When he said he was going to open up a restaurant, a lot of people that were in the business kind of snickered at that. But he was very, very successful from the time he opened, and then he moved it over to Royal Street, became more successful. That restaurant is still there. That's the original Brennan's on Royal Street. And then the family got big and also got into some different points of view on things. So they split up somewhere around in the mid-1970s, and part of the family took the money that they derived out of the original business and went over and bought a little kind of beat-up neighborhood restaurant called Commander's Palace, and literally in a 25-year period turned it into a world-famous restaurant, normally ranked in the top 10, certainly in the United States, which is an entrepreneurial story in and of itself. My sons and I, I'll tell you how we got into the business. My oldest son, his name is Rick, and when he was your age, he was graduating from college. And so we went, father and son are talking about, okay, Rick, what are you going to do now? Because I'm sure that is true of all of you. You know exactly what you're going to do, right? All of you, you've got it all figured out. Well, Rick graduates from college, and he went to a good school just like this. He went to Ohio Wesleyan, which is very similar in many ways to Loyola, and liberal arts graduate with some business and economics major. And he said, Dad, he says, I don't know what I want to do, but I know what I don't want to do. And he says, I don't want to work for your friends in these great big companies that you do all this consulting work for. He says, I think I want to do something on my own. So I said, well, what do you want to do? He says, I don't know. So I said, well, I'll tell you what, Rick, I'm going to write you a check for enough money for you to, I want you to go to Europe. And by the way, here's the names and addresses and phone numbers of all these friends that you want to work for, but in case you need anything or something, you may want to give them a call. So the deal was he had to leave the country, go out and get out there and kind of learn. And he did meet up with quite a few of these people, by the way. They were very nice to him. And in October, the same year he graduated in June, his mother went to visit him, and they were over there, and they called me up, and they said, what about opening a restaurant? I said, well, that's interesting. I said, down the street from my office, my office was in an area called German Village in Columbus, which is a historical neighborhood. And I said, there's a restaurant that's surely about to go out of business. And it's terrible. The man that owns it doesn't work the business. He's left it to his mother, and she's totally bewildered, and it's just awful. But it's in a beautiful neighborhood, and a beautiful building, and I think we could buy it. So they asked me if I would please look into it, which I did do, and I called up the owner of the building. He was thrilled because he hadn't gotten any rent in a year. And then I called up the operator and talked to him. He was thrilled because it was killing his mother, and he didn't want to go back into the business, and he owed the bank a lot of money. So we bought this restaurant for enough money. It was about $135,000. That was what he owed the bank, and that's exactly what we paid for the business. $135,000. It wasn't worth that much, but it got him clean and got him out. Then we bought the building for $235,000 and ended up going to one of the large old hotels in Columbus was going out of business at the same time, and we went down and bought a lot of used restaurant equipment at 15 cents on the dollar, and then we redid this restaurant, and we positioned it as an Upper East Side New York sort of restaurant, a casual restaurant, smart casual, if you can kind of get that term. People would ask me later on, what is Lindy's? What is it going to be? And I say, Lindy's, think about Lindy's as an adult TGI Fridays. Okay? It's really not mostly for your generation or people in their 20s who are very sensitive to budgets and also 25, 30 years ago, all those tchotchkes were on the wall and all this kind of to decorate the decor back. Lindy's wasn't like that, but it wasn't fancy. It wasn't old-fashioned fancy. We didn't have waiters in tuxedos. We didn't have people that bowed to when you came in. It was white tablecloth, but we put bush block table on top of the table, another white tablecloth, so we had kind of the look of a real restaurant without some of the expense issues. And we opened this restaurant literally, it was 25 years ago, last June, just a few months ago. And Rick went in there to run it, along with his mother went in to help him, and that was kind of interesting because after 2 years, he went to Cornell and got his MBA at the famous hospitality school at Cornell, which I guess is still ranked #1 in the country. And And his mother went in there, and she never left. She still runs the place. And then, interestingly, he went on and he went into business with a few other former employees of mine into something called the Steak Escape. And he was going to make millions of the Steak Escape, but when he found out the franchisor was making more money than he was, and so he got discouraged, sold those off to some Vietnamese families, which, by the way, if a business is below a certain size, it really needs to be family run. Because, you know, it just works that way. And then that's when 14 years ago now, Bravo opened with a single restaurant, which was an Italian-themed restaurant in Columbus, Ohio. Bravo was sophisticated Italian. Some people would say, what does that mean? It means sort of northern Italian, Tuscan-style cooking, not necessarily meatballs and spaghetti. It is in Sicilian style of Italian, which is the old-fashioned American immigrant Italian, Sicilian style. And there's nothing wrong with it. As a matter of fact, there's a chain of restaurants that sort of capitalize on this Sicilian style called Buca di Beppo. And Buca di Beppo, you know, is so absurdly Italian that there's one large table in every Buca di Beppo. Maybe you've seen it. It'll serve about 12 people. In the middle of it is a plaster bust of the Pope. And this is how funny that is. It's very, very, it's an amusing business, but it's a completely different business than Bravo. Have any of you been to Bravo on the Avenue before it closed? We did. That's the one Bravo that we did not reopen, and it was related to the hurricane. But anyway, we started with a single restaurant 14 years ago. And when we sold the company this summer, there were 55 restaurants. I may be off one or two, because there may have been 53 open and 3 under development, but that was about the neighborhood. It was a business over 200 million in sales. And who would buy a business like this? Have any idea? I'll give you the answer. It was bought by some professionals who are money people. And their job is to make this investment and to grow it much faster. To grow it from 50 to 100 stores, and then they'll either make it a public company or they'll merge it into a very, very large restaurant company, such as a Brinker or someone like that. And why would they do that? They would do that because the value of the company will probably double or triple as you go from the 50 stores to the 100 stores, because there are efficiencies involved. There are disciplines involved. There are disciplines they can bring to the business. My son Chris, who's the younger brother, who's a Tulane graduate. Chris will be here next week working with us. And I remember this conversation very well 3 years ago when I said, you know, Chris, if we're going to take it now from where it was, 30 to 75 or so, you really have to probably take 6 weeks out of your life and go back to Harvard or go to Stanford or go to Northwestern. You've got to go to what is known as an AMP program, an Advanced Management Program. Because there's just so many technical things you need to know as you go the business from 50 to 100. And Chris said to me something I thought was very interesting. He said, you know, Dad, he said, I don't want to do that. He says, I think I'm really good at going 0 to 50. He said, let somebody else do that. Somebody that's really a pro. Somebody that knows really how to take a business this size, because there's 5,000 employees in that business, and take it that size and then move it to the next direction. I'll be doing it for the first time. I don't particularly want to do it for the first time, because I think the second time around, I can do this 0 to 50 thing better, faster, cheaper. And so we'll talk about that. We'll talk about how we got to where it did, how we got this kind of valuation, and then we'll also then talk about, we're about out of time, right? We'll talk about what do you do with all that money? Because, you know, a lot of people have a very peculiar, it really hasn't changed his lifestyle at all. He hasn't bought a bigger house, he hasn't bought a bigger car, and anything else. Now, some people wouldn't do that. That's bad, but in any event, basically what Chris will do is probably take some of the capital that he now has, I'll do the same, and we have already got in mind what we might do in a broad outline next time time around, trying to, again, do it better, faster, cheaper. I think, since we didn't have any questions, if you have questions, by all means, write them down, and we'll try to get to them, either one way or the other. Okay?
Thank you so much.